Well, let's go ahead and get started. So thank you again, everyone, joining live, or if you're watching the recording. I'm Jordan Fry from the Prudent Plastic Surgeon. I am super excited to be joined today by the team at Gelt. Gelt is a very modern tax advisory firm focused on helping high-income professionals like doctors make smarter financial and tax decisions. I'm like a broken record saying taxes are every doctor's biggest expense, and you really have to be proactive about planning for that expense. And so we have Rachel Richards here with us today, who is a CPA at Gilt, works closely with her clients on exactly that proactive tax strategy, entity structure, long-term financial planning. And Gelt really focuses on a very practical, actionable perspective to these conversations, especially with the aid of technology, to really optimize and make the best decisions. So this is going to be a super exciting discussion. We're going to talk about, tax season, if you filed an extension, is not over yet. And if there's anything for those of us that are on extensions to do, what we can do going into 2026 and some major pitfalls to avoid. So Rachel, thanks so much for being here. Super excited to have you. I'll pass it over to you, and we will definitely have time for Q&A and stuff. So if you do have questions, please feel free to throw them in the chat.
Awesome. Thank you. So let's get right in. April 15th just passed. Maybe you filed an extension. Maybe you managed to get all of your tax documents ready and you filed your return. But we really want to focus on today is that April 15th shouldn't be the main event for your taxes. Right now, we're in May 2026. The focus is really on planning for 2026. So when you're filing your taxes in 2027, you're not scrambling and thinking, oh, what can I do to lower my tax bill or getting a big surprise, but you really are prepared. You know, you're confident that you've already optimized your situation, and tax filing should really just kind of be tying up all the loose ends and putting a bow on top. It shouldn't be this huge stressful event, which I think so often it becomes because nobody likes taxes. It's something that always goes to the bottom of your to-do list. And we kind of want to encourage you to break those barriers and be more proactive about your tax planning throughout the year. So what we'll cover today is if you are on extension and you haven't filed your 2025 tax return, what that means and what opportunities might still be available to you. And then regardless of where you are for 2025, we're in 2026 now. So what can you do for 2026 to set the path for this year and future years, optimizing your taxes? And then we'll talk about some strategies that you might have heard of, some things that buzzwords that people will talk about, whether or not that's something that'll really apply to you. And then, of course, we have time for questions at the end. So throughout today, we're really focusing on two different personas. And sometimes you might fit into both roles. So we usually have W-2 employees where you're earning a salary, you might be working in a hospital, or a 1099 or business owner. So you're not getting that employee compensation, you're responsible for your own taxes. And while that can make your taxes more complicated, that also really unlocks a lot of opportunities. We really encourage our clients, if there's an option where you can wear both hats, even if it's with some side work, usually having a little bit of both is really going to maximize your benefits. Okay, so first things first, you're on extension. What can you still do? And I want to cover just a little bit about what an extension does do and what it does not do because the difference can easily be confused. So an extension is an extension of time to file. It is not an extension of time to pay. So let's say you filed an extension. That's great. You're not going to have any failure to file penalties if you file by October 15th, but you still have payment obligations. So if you filed an extension and when you file your return, you're going to owe $50,000. Then every month that you don't pay that $50,000, you're going between April and whenever you file, you're going to have a failure to pay penalty, which is 0.5%, and you'll also be paying interest, which right now is at 6%. So on that $50,000, you're paying about $500 a month carrying cost by not paying in that $50,000. And that's something that for some people can actually be a strategy. And they think, okay, it's only going to cost me $500 to keep this liquidity. Awesome. I'm going to wait as long as I can to pay the IRS. And that's totally fine. I just want to make sure that you guys are aware of what costs are accruing if you do have a balance. And if you're not sure if you have a balance due, now is the time to really do a tax plan for 2025 and understand exactly where you might be so you can stop any penalties that might be accruing. Your extension is also going to give you some more time if you have a business to make retirement contributions. So, with the Secure Act a few years ago, they implemented some new rules where even though we're in 2026, you can still set up a 2025 retirement plan for your business and make contributions for 2025. So you could easily have a five-figure deduction for 2025, so you'll get the benefit on your taxes now, even though you're setting up that plan a year late. Obviously, if you're putting money into the plan sooner, it has longer to grow, but you still have opportunities there. And you also have time, buy yourself time to collect your tax documents, to find those charitable contribution receipts that you might be missing. And if you have real estate, you can also potentially do a cost segregation study and get those benefits for 2025. Let's see. Okay, what an extension does not do, it's too late to contribute to an HSA or an IRA for 2025. So that window did close on April 15th. So those are kind of the ins and outs of what your extension period should mean to you. Okay, and we've covered most of these already, but just to go through in a little bit more detail, things you can still do by October 15th. If you're on extension, you can still make a SEP IRA contribution, a solo 401k contribution, all of those employer contributions. If you have a business, you can still do that cost seg study. If you have if you're self-employed and you've been filing as a Schedule C and you've heard about an S corp and you're not sure if an S corp is right for you, that is still on the table. You can do a retroactive S election. Um, it's going to be a little bit more complicated now that the extension deadline has passed, but nothing crazy. What would happen is you might get a late filing penalty, but it can usually be abated for the first time. And you can always amend your return if you found missing deductions or there's an opportunity that you missed out on. You have 3 years from the time that you file your return or 2 years from the time you pay your taxes to amend your return and get money back. So you still have a lot of opportunities available. And the things that have closed are like we talked about, the IRA contributions, the HSA contributions, any Roth conversions needed to happen last year, um, and employee deferrals on a 401k, because that's going to be reported on your W-2. Let's see. Okay, so some things that you can do before October 15th. You can still make those retirement contributions. You could still do the cost segregation study, all of those things we talked about. This is just another way to show just who those different strategies apply to. So anyone can always amend their return, update their withholding, and then the S election, retirement contributions, those are going to be more specific for business owners. And the cost segregation study is specific to your if you're involved in real estate. Okay. So now moving on from 2025 and talking about where we're at right now. So everyone here should be planning for 2026 in 2026. If that's the one thing that you take away from this, that's really the key to what you should be doing. And whether what that means to you is up to you. So that could mean that if you just want to know what you're going to expect to owe, that's a great starting point. If you want to know how to, if you get to, okay, I know what I can expect to owe and I want to make that number better, that's a perfect elevation of that. So you're going to get as much as you give when it comes to planning because planning is really about what makes the most sense to you. There are hundreds of strategies available, but not all of them, if you're not interested in real estate, you probably don't want to become a short-term rental owner and be a landlord managing an Airbnb because it's going to take, you get the tax benefit, but it's going to take time. It's going to take away from other things that you can be doing. So what we like to do at Gallup is really find things that are going to fit into your life. So just at a high level, I want to talk about some things that you can still do this year. If you receive a W-2, and that could mean you're solely working as an employee, or it could mean that you have your own business and you're paying yourself a salary, this is a great time to check on where your withholding is. So take your most recent pay stub, send it to your CPA, or the IRS even has some tools available where you can check your withholding and see where you're at and potentially adjust your W-4 to make sure that you're withholding the right amount. Something that a lot of people will associate getting a refund with getting a good tax outcome. But that's not necessarily true because getting a refund doesn't mean that you paid less tax. Getting a refund means that you paid in more than you actually owed and you're getting money back. So we really try to discourage the like better refund equals better outcome mindset because if you got a big refund, you gave the IRS an interest-free loan. Like it's not necessarily indicative that you did something really special. Um, so, so instead of focusing on getting that refund, we want to focus more on making sure you understand what you're going to owe and you're paying in the right amount throughout the year. So checking on your withholding and also managing your estimated taxes are two really important ways that you can do that. You also want to max out your retirement plan if retirement plan contributions are important to you. Again, if you're like, I don't want to invest in a retirement plan, real estate is going to be my retirement plan. I love investing in real estate. Then there are a bunch of strategies that are going to be great for your real estate investments. So a common theme here is really going to be making sure that the things that you're doing are going to speak to what you're interested in, because your taxes should really be serving you. If you have a high deductible health plan, then contributing to an HSA is a great option. HSAs are triple tax advantage. So that means that you're getting a tax benefit when you're making a contribution, what you're contributing is growing tax-free. And when you're taking the money out, if you're using it on qualifying expenses, you're not paying tax on that money. So that's a really great benefit. If you're into investing, then you want to make sure you're harvesting losses at the end of the year to manage what you'll have in capital gains. And sorry. Whew. If you are really into charitable giving, a donor advised fund is also something that you might be interested in, where you're going to get multiple tax benefits from different angles. Okay, so shifting, shifting a little bit. another thing that you really want to focus on when you're planning for 2026 is how your tax situation is structured. So that can mean your entity structure, which is how you're earning income. And if you don't have a business, that could also mean how your assets are being held. So if you hold your assets in a revocable living trust, for example, that could be a strategy to help facilitate an easier retirement planning down the line. So one thing that we like to do at Gelt is really look at the structure of our new clients to make sure that what they have going on is going to be working for them. So right here we have a common structure that we see, which is where you have a PLC or a professional business, and you'll make an S corp election. So we'll often have people come to us and they're earning a lot of income, but they're not filing in a tax optimized way. So instead of they're filing everything on their personal tax return, which is the easiest thing to do, you have the lowest compliance that way, but it's not the most tax efficient thing to do. So, one analysis that we'll often run is whether or not you should make an S election. And so when you're making the S election, instead of paying on all of your income tax, Social Security tax, and Medicare tax, instead of paying those three taxes on all of your income, you make an election and then you file two tax returns now. You'll file a tax return for your S corporation and your personal. But on that business income, you'll still pay income tax on everything, but you only pay the Social Security and Medicare tax on the amount that you're paying yourself. So, in terms of savings, that can quickly turn into five-figure savings. And the more that you earn, the more that you save from that S election. So, this is a really important consideration, especially if you're making 80 to 100 over 80 to $100,000 a year in profit and you foresee that continuing for a long time. This is definitely something that you would want to consider. With every strategy, there are going to be benefits and also costs. So instead of filing one tax return, you're going to file two. So you definitely have higher compliance costs. And then you also have reasonable compensation requirements. So a lot of the benefits of having that S corporation really come from being able to give yourself that salary, and that salary is not going to be 100% of your business income. So, with that reasonable compensation requirement, the IRS is saying, okay, hey, I'm aware that you can get this benefit from the S corporation, but I want to make sure that you're not taking advantage. So, whatever you're paying yourself needs to be reasonable. And they don't really give you a definition of what reasonable means. Um, so I know at Gelt, we have a reasonable salary study that we can run for you. There are tools available to make sure that what you're paying yourself is going to maximize your tax benefits because there are a lot of different things that are going to affect that. Your salary affects how much you can contribute to retirement plans, for example. It affects your QBID deduction. There are a lot of things that are affected by your salary. So we really like to kind of run the numbers and see where your most optimal salary is, and then gut check that with that's the most optimal number, but is it going to be reasonable? And find a way to meet in the middle. So, reasonable salary is something that you definitely want to watch out for if you're thinking about that S election. And then also be aware that it is going to make your situation a little more complicated. You'll have higher obligations on how you can do your accounting and financial statements, and you'll need to be filing those additional tax returns. Okay. Now we're going to get into some other moves that you might want to consider. And this is, we have eight here, but there are hundreds. And I can't emphasize enough that the right strategies for you are so dependent on your tax situation. Depends on where you live, what your family looks like, what's important to you. There are things that we can recommend that can save you a lot of money, but if it's not something that fits into your life, then it's not worth it. So keep that in mind as we're going through all of these, that, if there's not something that speaks to you, that doesn't mean that it doesn't exist. It just means that it didn't make it into the top 8 here. So the first one that we have is PTE elections. So this is something, depending on the state that you're in, because a few years ago with the Tax Cuts and Jobs Act, they really started limiting what you can deduct as far as state income taxes. More recently, that increased from 10,000 to up to $40,000, so it is getting a little bit better. But in response to this limitation on state income tax deductions, some states, California is a really popular one, introduced this pass-through entity tax election, where instead of paying your state income tax at an individual level, your business can make an election to pay the state income tax at the business level. And what that means is that your business gets a deduction for that tax, which will lower your federal taxable income, and essentially let you take a deduction you're still paying the same amount of tax, but by paying it in a different way, you're able to get a bigger benefit from it. So in a lot of cases, this might be a no-brainer for you. But depending on the state, it may or may not be offered. There may or may not be some caveats. I know specifically for California, the legislation was kind of poorly written. So the PTE tax payment that you made, it can reduce your tax, but you couldn't get a refund of it. So it required really careful planning to make sure that you weren't paying in too much PTE tax. Otherwise, that money would get kind of stuck with California and you could carry it forward. But if you had really low state income tax, you might be carrying it forward for a number of years. Then we have QBI optimization. There are a lot of acronyms here. So QBI optimization, that means qualified business income, which is a deduction of up to 20% of your business income, that you can take right off the top and reduce your taxable income on your tax return. But it requires planning. So what that means underneath where it says 2026 SSTB phase out, that means that one of the limitations for this deduction is if you're considered a specialized service trader business, which most medical professionals are, then once you start hitting that 400 or $500,000 income, depending on if you're single or married, the benefit that you can get from that QBI deduction starts phasing out and your benefit could go to zero. So that's where really careful planning is required. And if you're, in a place where you're on that threshold, maybe making a retirement contribution is going to make the difference between getting that deduction or not getting that deduction. So that's where planning really comes into play. And it's important to do things during the year because if you find out on April 15th that if you had $10,000 more in deductions, that you would have qualified for the 20% QBI deduction, then there's not a lot that you can do. But if you find that out in December, then you could maybe prepay expenses. You still have options available. So the sooner that you can plan, the sooner you can take advantage of those opportunities. We talked about cost segregation studies a little bit, but if you're into real estate, this is something that you can potentially do to help accelerate your depreciation. With the recent legislation that passed last year, we do have 100% bonus depreciation in place permanently. So that means that if you own real estate, those things that aren't considered the building, and the building, the land, etc., the things that are tangible personal property, those potentially can be 100% expensed. So a cost segregation study helps you break out your property into those smaller chunks so you can get more depreciation and get a higher deduction upfront. Caveats with cost segregation studies: if you have a lot of rental properties and you're not going to be able to use the deductions because they are going to be just carried forward, a cost segregation study will give you value later, but it might not have that immediate benefit. So that's where planning and your own personal situation are going to affect whether or not that's something that you're really going to benefit from. Another one, if you're into real estate, is oftentimes if you're really busy, but your spouse is really into real estate, you guys want to have a couple properties and manage them. One thing that we'll see is a stay-at-home spouse might end up becoming a real estate professional because they can qualify, spend enough hours, and then that opens the window to where usually your real estate losses might not be deductible. If you do have a real estate professional in your household, then you can unlock deductions that wouldn't otherwise be available to you. So it's really something that's really cool for the right person. But if someone says, "Hey, I have a full-time job, but I have three rental properties, can I be a real estate professional?" That answer is going to be no. It really has to be something that you're doing full time. So that's where it needs to fit into your life. It's something really cool, but it does need to fit into your life to have an impact. A couple more. We have the Augusta rule. So that's where you can rent your home to your business for 14 days a year. This was actually created for the Masters, the golf tournament that they have in Georgia every April. And so if you rent your home to anyone for less than 14 days, that rental income is not going to be taxable to you. So that applies in any situation. But one way you can use it as a business owner, you can rent your home to your business for less than 14 days a year. Your business is going to get a deduction, which usually, if your business has an expense, someone else must have income. But in this case, your business can have an expense, but you don't need to pick that up as income. So it's a way to reduce your taxable income and personally benefit. So you do need to, there are rules around it. You actually have to conduct business in your home, and have, meetings or events there. But that can be a really cool benefit. If you have kids, you can hire your kids. This not only will reduce your taxable income, but for your kids, it could open up opportunities for them to contribute to an IRA, a Roth IRA, or something that some of our clients are get really excited about is they put the money in a savings account. That can be their college savings. So when they go to college, you can give them a debit card, and that can be their spending money. There are a lot of cool, fun things that you can do around hiring your kids. But again, they have to actually be doing something. So maybe they're a model, maybe they're helping out in the office, but there does need to be some legitimate work involved. And then just a couple more niche things. If you're really into retirement planning, particularly having that tax-free income in retirement, or you really don't want to have required minimum distributions in retirement, then mega backdoor Roth contributions could be something that's really exciting for you. It's not going to reduce your taxable income today, but anything that you contribute to those plans will grow tax-free, and in retirement you'll be able to enjoy tax-free income, which can be really special, especially if you're collecting Social Security. Maybe all of your Social Security will come through as tax-free depending on your situation. Lots of cool things, but that's something, again, you want to not only think about how can my taxes, how can I improve my taxes or pay the least amount as possible now, but what's that going to look like over the next 5 years, 10 years, 20 years? Because you want to look at the bigger picture as well. And then charitable remainder trust, that's kind of like an advanced donor advised fund. So if you're really big on charity, you can contribute to an asset to the charitable remainder trust. You're going to avoid capital gains. You can enjoy income from that asset throughout your life, or say for up to 20 years. But then once that has expired, then the asset is going to be contributed to charity. So you do need to be willing to part with the asset permanently, but there are options to enjoy income from the asset throughout your life. Let's see. And then we've talked about a lot of strategies today, and we've kind of brushed a little bit on them. There are definitely lots of other opportunities, and it all depends on what you're interested in. If there are solar investment credits, lots of different tax credits available. And really, what we try to do is find the strategies that are going to work into your life as it is already. Taxes are my life, but taxes shouldn't be your life. So some key takeaways, things that you can do right now that'll make a big difference. Look at your most recent tax return now that you're not in a crunch. Take a look, have someone else look at your tax return and make sure that there weren't things that you left on the table. If there are opportunities for a refund, you could potentially amend your return and get money back, or you can learn what you should be watching out for next year. Think about how you could have done better. Next, look at your 2026 year-to-date income. Understand where you're going to be right now, because that's going to set, once you have a starting point, then you can start thinking, okay, where's my exposure? Where can I make things better? What things am I interested in doing, and how can I do those in a tax advantageous way? And then if you are on extension, make sure you know what deadlines are coming up and make sure that you don't miss them. If you file on October 20th, that could be really expensive. You're introducing a whole new failure to pay penalty. So make sure you understand what your limits are, when things are due, when you need to make retirement contributions, if that's something that you still want to do for 2025, so that you're still on track. And I think that covers it. I know we've gone over a lot, so happy to go through any questions. And a couple of things that you can do to keep the momentum going. Following this, we'll send a quick checklist covering some of the topics that we went over today. And then if you want to learn more about gout, you can always book a consultation with our team, and we can send a link out in the chat. And I know it'll also be in a follow-up email tomorrow.
Awesome, fantastic, Rachel. That was an incredible overview. And I liked kind of breaking it down in terms of the time frames and going through everything step by step. So I appreciate that. What is like, what would you say have been some of the bigger misconceptions that you've seen like high income individuals have when it comes to tax planning? Um, and obviously everyone throw your own questions in the chat. I just kind of throughout had been thinking about that.
Yeah. I mean, something that has been kind of top of mind recently, um, people have come to us and they come to us and we have like one owner is really high earning physician, and then their spouse maybe dabbles in real estate or is a lower income earner,
Mhm.
and they're filing separately because that's how they keep their finances. That's just what they've always done. I had a client where all we did was change their return from married filing separately to married filing jointly. and we were able to get them back 3 years of six-figure returns.
Wow.
So just something so simple as how you're filing, which, you think there could be a difference there, but the more it's really specific to your tax situation, so it can make a huge impact. Just those small decisions like that.
Yeah. Yeah, that's huge. Um, the other question I had, like, I know obviously you're not the person kind of heading up these investments, but can you talk a little bit about like the just overall kind of general like advantages, disadvantages tax wise and investment wise of things like um, solar investing you mentioned, like these maybe even opportunity zones, like these types of investments that may be able to help pure W-2 earners to shelter some income. But again, there are some downsides and you don't want to let the tax tail completely wag the dog. So maybe just to go a little bit into that, because I've seen where some people will go into investments just thinking about the tax benefits, and you're kind of like, well, you're like almost paying more to pay a little bit less in taxes, and it doesn't always add up. But in other cases, it can
Yeah.
be really worthwhile. So your thoughts on that?
Yeah, so with like the solar investments or opportunity zones or even conservation easements are some that we'll get asked about a lot. And there are amazing tax benefits. If you want to only focus on taxes, go for it. But the other side of that is you are making an investment. So is that going to be a smart investment? Are you going to get a return on that investment? What could you be doing with that money otherwise? And, what's your opportunity cost with making that investment? Because the tax savings are great, but not if the other costs are going to outweigh them. And then also think about what kind of obligation you're getting yourself into in order to get that benefit. So specifically with the solar credits, people will think, okay, this is, it's going to be so easy. I just, find these solar investments and I'm done. But in order to actually qualify for that credit, you do need to have material participation, which, if you're really busy, isn't necessarily the easiest thing to meet. So there are intricacies and criteria that you need to make sure you're aware of and make sure you're willing to invest in, whether that's, time, documentation of what you're doing, all kinds of things. So people sometimes will feel a little bit bait and switched, like, oh, I thought I was going to get this huge benefit, but then I realized it was going to be all this work, and I'm not really that interested in it.
Yeah, that's such a great point. I invest in real estate, and my wife has real estate professional status, and she manages everything. And it's a lot of work. It's a lot of documentation, and we've been audited and had to prove everything, which we did because we had everything documented and followed the rules. But it's not an easy thing, and it definitely is not something that I can tell you, would not feel worthwhile if you were just getting the tax benefits. Like if you bought properties that were not cash flowing and not otherwise good investments just for the taxes, it would it wouldn't be worth it. It just
Yeah.
simple as that. Um, so
Really, the perfect example of that, because so many people are like, "Oh, I'm gonna get a short-term rental. I'm gonna be able to offset my W-2 income." But you are actually buying a property. You are hosting people in that property. You are having to really participate in order to get those benefits. And if you're not into it, then you're gonna regret the decision.
yeah, exactly. That's the key is you have to I think you do have to find it interesting to a certain degree, and you have to have a very strong why and plan in terms of like where it's going to get you. Um, yeah, so that's awesome. Um, so talk a little bit, if you don't mind, just about like let's say someone. I'm sure a common thing you guys kind of hear, someone's like, you know what, I just filed my 2025 taxes. I really didn't plan, or the person I was with before didn't plan proactively, and I'm unhappy where things are at. I'm interested in seeing like if Gelt can help me. What's that kind of process of starting to work with you, and like how do you guys structure that?
Yeah. So we'll always take a look at your prior year tax return. Number one, to just understand where you're coming from and what carryovers you have, what opportunities you might have, if there's a refund opportunity. But then in the beginning, we really focus on understanding your situation and what's important for you so we can build that plan and make recommendations that are going to be meaningful to you. So if you come to us and you're like, taxes are life, I will move to another state, I will do anything to pay less in tax. And we have had people move to save taxes, and that's awesome if they're willing to pick up their lives and make a permanent
Yeah.
move. So we really try to find out what's important to you, so that we can steer you in the right direction and not just be throwing things at the wall.
Awesome. And then will you guys kind of go throughout the year, like in terms of planning projections, as to give a sense of like, okay, maybe we need to do something more, or hey, maybe we should be looking at these opportunities, to offset some more?
Yeah, it depends. So we have different plans available, and what we do kind of depends on what we need, what you need. So if you're coming to us and you really have everything set up, and you just want, hey, like once a year, I just want to check in, make sure I understand where I'm at, if there's anything I can do. Sometimes that's enough for people. And then we also have plans where if you want every quarter, we'll run a projection with you. We'll come to you with new ideas. Really, that like really intense proactive service.
Mhm.
It just really depends what you want and how much you're willing to invest. Because if you don't want to sit down and talk to us 4 times a year and talk about where you're going, what changes are happening, then you might need like one or two touch points throughout the year might be
Yeah,
enough for you. So we try to, create a service that's going to fit within your needs.
that makes a lot of sense. Um, okay, awesome. Any last minute questions to come through the chat? This is like a pretty rare opportunity to get access to a really expert tax professional, not on the clock. So definitely feel free to put them in. Um, how often do you see specifically physicians either transitioning from like a W-2 to a 1099 situation, or creating another separate entity, 1099, maybe it's a side business to kind of benefit from the increased tax flexibility that you get with that?
I would say it's really common. Either transitioning, if you're at a hospital or if you are transitioning to owning your own practice, we can kind of go with you from the start, or just having some sort of side income. And it doesn't even have to be medical related.
Hmm.
Um, just any kind of side business can open those opportunities for additional deductions. It really depends on where you're at in life and what you're into. Obviously, we we can't change how you are going to make your money is not really in
Yeah.
our control. Um, but we see it pretty frequently.
Okay. Awesome. Well, Rachel, thank you so much for your time and sharing all of this. I definitely learned new stuff and I appreciate kind of going through this with you. What we have the link in there for anyone who's interested in potentially learning more. Is that the best way to get in touch with you guys?
Yeah, absolutely.
Okay, perfect. Well, thank you everyone who was joining live. If you're watching the recording, thank you, Rachel and team. Thank you so much. We will be sending out, in addition to the tax planning checklist that Rachel will be sending out, we'll be sending out the recording and everything as well. So thanks everyone and have a great night.